The amount of gold that's come into the country, Mark, is ridiculous. I mean, it truly is. It is unprecedented. And to give you an idea, every time I've been on your show this year, I've screamed about how much gold is coming in the country, right? And okay, but just to give you an idea of what I'm talking about here for the August delivery contract, in the first 3 days of the August delivery contract, um, 20,000. Before I say that, forever I would say to people, look, less than 1% of contracts issued on COMEX my entire career, 35 years, ever stood for delivery, ever. Now, they're all standing for delivery. I mean, tons of them. And a lot of it's leaving the COMEX. It can be delivered, but that means delivered to COMEX. And then loadout means it's leaving the ecosystem. Bye-bye, gone. A lot of it's doing that. But in the first 3 days of the August contract, 20,126 contracts stood for delivery. Each contract is 100 ounces. That's over 2 million ounces of gold, and has a value of approaching $7 billion. And what's really significant, even aside from the fact that the early numbers in a month that isn't a major delivery month for gold, August, huge volume. But what's even more interesting is that every single contract that's been issued this month so far has been stopped, which means stands for delivery. It's a 1-to-1 ratio. That means physical delivery is actually taking place, not just speculative paper settlement, in a 1-to-1 ratio. Every one of them, 100%. So when you realize that less than 1% used to stand for delivery, 100%, and the question, and a lot of it leaves. So who's buying 7 billion worth of gold in the first 3 days of the August contract, which can now be delivered? And there's still a lot of open interest left, meaning open contracts that can stand for delivery. So when it's all said and done, it could be a lot more than just what has already posted for delivery, and it will be. But the point of it is that he's right. I think he's very right. And I've been saying that I do believe, remember, that Judy will said they're going to issue gold-backed treasuries. Well, on July 4th, 2026. The reason that this could actually work would be to peg the back end of the treasury market, the bond market, to gold and have it deliverable. And the reason you would do that would be that you could have zero interest rates on the long maturity bonds at zero, and peg it to gold redeemability. That acts as the interest rate. It acts as the inflation hedge. And I believe that's what they intend to do. So if they revalue gold, as everyone keeps talking about, and I've been saying it on your show for over a year, what's it held in? Gold revaluation account. Now, again, everyone is saying it. And I've been saying it for over a year they're going to do this. Maybe I'm just stupid that I say it out loud in front of millions of people. Maybe I have the courage or the stupidity, not quite sure. And that's how it was with BRICS. For 5 years I said this shit and no one said it. I got laughed at. You let me say it, and yet now everyone talks about it. And that's what's made me kind of well known in this industry, is my thesis on the BRICS, 5 years old, 5,000 videos on it. There's proof out there. No one was saying it. I am. So what I'm saying now is this new stablecoin bill. You're going to see corporations all around the globe issue stablecoins. You just saw JP Morgan yesterday said we've signed up with Coinbase, and we're going to start linking the accounts. First bank ever to do it. You can trade your earned Chase bank points into stablecoins, and the stablecoin issuance will all be backed by U.S. Treasuries. This is what they're trying to do. The legislation of it, regulation of it, is to monitor the on-ramp and the off-ramp, but it is to back the U.S. Treasury market with synthetic demand, not the organic demand. It's always had, but only the front end, up to 2 years. And that'll be Scott Bessent, the Treasury Secretary, says, yeah, we can get up to $2 trillion a year on that, probably more. And all of these stable coins will be backed by treasuries, which will keep the front end going on the government. Back end, how do you bring back manufacturing? How do you do it? We owe $28 trillion in 3 years. The treasury's coming due. We only take in $15 trillion in revenue. We have a $3 trillion a year deficit. That's 37 trillion in 3 years we owe. We bring in 15 trillion. There's a problem. They're going to destroy the dollar. I believe their idea is to destroy the value of the dollar, to lose the reserve status. We don't want it. And even Vice President Vance has said being the world reserve currency at this stage of the game because of Triffin's dilemma is not good for us anymore. We should probably lose it. He wrote that on White House letterhead. Triffin's dilemma says as the world reserve currency, you'll always run a trade imbalance. You cannot give the world enough dollars just through trade alone. So they sell their currency to buy our currency. We produce more currency. They buy our currency and sell theirs. Theirs goes down, ours goes up, meaning their manufacturing is way cheaper. So we send our manufacturing over there, creates a trade imbalance. This is part of the reserve status, which has kept our asset prices high, our interest rates low, and our goods that we buy at Walmart cheap. This would allow them, if they devalue the dollar by revaluing gold. Now, remember, James Rickards, who's one of the smartest dudes in the world, who's run simulated war games at the Pentagon forever, financial war games, says 24,000. There are a lot of people that are saying 15,000, 12,000. His number he gets to by dividing the amount of gold we supposedly have, I think, into M2. And you put it at 24,000, the Treasury wouldn't even need Fed approval, as we've talked about. Or congressional approval. They would just do so. The Fed would make it so. We would buy it from anyone that would want to sell it at that rate. Benefits every central bank on the planet because they've all been buying gold. And by doing so, you devalue the dollar in that scenario by about 60%. And the Treasury gets about 6 trillion free and clear. Every $4,000 increase, as I've said on your show, again, hammering it home. So you guys all remember this when it actually happens. Now,
Federal Reserve just released a report yesterday titled Official Reserve Revaluations, the Internal International Experience on the Federal Reserve site. Now, they're discussing it. So if that were to occur and they were to reprice gold at a level like that, the dollar gets severely depreciated that the Treasury issued its gold certificates to the Federal Reserve, who keeps the gold as security. That currency is then generated out of nothing. They issue it. Every $4,000 is a 1,000 jump to 24,000. That's 6 trillion. Fed can begin to reduce its balance, or the Treasury can begin to reduce its balance sheet. It's a bookkeeping trick. That currency was produced out of thin air. So that currency that is granted and printed diminishes the dollar drastically. But then you would, and by the way, the Fed doesn't possess that gold. They just have entitlement on the dollar value. But now you have a debased dollar, much elevated gold price, which enables you to clear things off. If Judy is correct, and they attach the Treasury to it on the rear end, July 4th, 2026, you begin marketing Treasuries with zero coupon, no yield, exchangeable in gold, which functions as the yield or the inflation gauge. And what would this accomplish? Well, let's analyze it real quick. What would it achieve? First of all, this would be, in effect, a mild default on the dollar. In other terms, we're no longer the reserve unit. And this is why you observe all of these nations forming this pact of cross-border settlement with domestic currencies clearing imbalances in gold. That's the entire basis of the bridge network and the BRICS, which I do intend to discuss in a moment. A progression that just is startling. Again, it's quickening what I referred to on your program many times lately. But in any scenario, you debase the dollar. You have enormous inflation to begin to reduce the 28 trillion in Treasury issuance that matures in 3 years. You can accomplish all of that, and then you have the stablecoins released to operate the front end of the curve up to 2 years and maintain the system running. The rear end has zero yields and a diminished dollar, which implies you can now repatriate your production, which is what he intends to achieve because you cannot market your products at a costly dollar. You get a trade shortfall. Instead, the dollar is degraded. Zero coupon rates imply you can transfer everything back at a zero expense to borrow. Return that, construct your vital infrastructure, and expand your way out of this dilemma for our coming generations. I truly do believe that gold is going to underlie the system, and it's going to climb beyond what people anticipate. And the repricing is to weaken the dollar, is to return our production back. Because if we don't, 60% of this nation is not college trained, and AI is going to cripple a lot of the white-collar professions. So where do people labor? And can we truly permit, all of our crucial production like pharmaceuticals? Who is imposing another levy on pharmaceuticals, absurd to your remark, to bring it back? But semiconductors, all this material, we must produce it ourselves. We must be the motor of creativity and production. We don't, and that's what we must repeat. And the only method to accomplish it without destroying the system with elevated rates is to tie something to the rear end of the Treasury, to maintain zero coupon rates and a debased dollar. Bring it back. That debased dollar permits us to market affordably. The zero coupon rates permit us to return it affordably, cheaply, without destroying the entire structure. So yeah, you in effect forfeit the dollar and the reserve model to reach a stage where we are the motor of liberty, creativity, production. It's just going to demand some hardship. Like I say, it's the Shawshank Redemption instant, where Andy Dufresne had to crawl through 2 miles of, well, to arrive at the opposite side. Well, we have to accomplish that somehow, some way. And that's what this is. So I would declare that silver is the most underpriced resource in the globe. Then if gold ascends exponentially higher, silver will trail it to a large measure, certainly. They told me that there would be 2 resets. The first one would be artificial, and I think you would concur. We're in the middle of that right now, Mark. And the second one would be Mother Nature. The artificial reset would collapse. The Mother Nature one wouldn't. And when Mother Nature assumed control, the U.S. administration would seize anything that was not U.S. in source. Now, this originates from Jim, and he meant it. He said it. So take that for what that signifies. I mean, if I had my preference, I would purchase only American. But for those of you that don't, look, for the first several years that I knew you, Mark, and during the pandemic, I advised everyone, do not purchase American-made because the surcharges are too elevated. And they were. During the pandemic, Silver Eagles were $14, $15 above spot. You can purchase them now. They're logical now. Then they weren't. Old Eagles were $250 above spot. Wasn't rational then, but it is now. So if you own Krugerrands or Maple Leafs or Kangaroos or Bars, it was due to the worth that you received in the total of ounces. As my guide Richard Russell used to remark, in the end, all that matters is the quantity of ounces you retain. Now, I would qualify that by remarking, don't be penny wise and pound foolish. Don't possess all of your material in 1,000-ounce silver bars and, kilo gold bars. The absence of adaptability will cripple you. So instead, in an ideal world, yes, you acquire 1-ounce gold and silver American Eagles and gold Buffaloes and pre-33 gold. All of that material is excellent. But the first 3 years I knew you, it had zero logic to acquire it. So take that for what it's valued.